Jonathan, I think of car dealerships as kind of a bad business. The dealers are caught between manufacturers who want to manage inventory and frugal consumers and are left with precious little margin. But you had some good things to say about the publicly traded UK dealers in the Lex column today.
I did. I think there are two things going on. One is the simple thing. There is a cyclical recovery in car sales. During the financial crisis, car sales slumped, as you might expect, and there's pent-up demand which is being released now, and car sales have been doing very well. Now that's a cyclical thing that will pass.
Yeah. A bad cyclical business is still a bad business in the upturn. Right.
That's right, but there's some evidence that the motor retail market is getting less cyclical. There's some structural stuff going on as well. And the most obvious thing is the very substantial growth in the use of personal contract purchase in the UK, which is to an American would be simply known as leasing.
Yes.
And this is where basically the car manufacturer takes a lot of the risk. So they basically supply the car and they take the credit risk, and they effectively agree to take the car back at the end of the 3-year term, and all the risk of that is borne by them. And that's very good for dealers because it encourages, it makes cars more affordable to users on a sort of monthly cost basis, which means that you know perhaps you're more likely to get a Volkswagen or an Audi than you are a Ford or a Vauxhall. So the initial sale can be at a higher margin, and also if the plan rolls over after 3 years, then you replace the car after 3 years. So that's good repeat business for dealers.
Now, the sweet spot in the dealership business, as I know, as a long-suffering car owner, is the service business. I buy a car at the dealer, it breaks, I take it to the dealer, they charge me an exorbitant sum for fixing that problem and maybe finding another. How is that part of the UK dealers business working?
That's exactly the same here, I'm afraid. So for consumers, yeah, servicing is expensive. Dealers are getting very savvy about servicing though, so they're offering things like fixed price servicing, so you pay several £100s for 3 years of servicing, and so on. And they're attaching those kind of deals to used cars now as well as to new cars. And that's very good for them because it brings customers back, it prolongs the relationship with the customer. And also because the margins are so much better. You sell a new car to a consumer, you might make 5% perhaps on that. Margins on parts and servicing are of orders of magnitude higher than that, typically 40% or more.
It sounds a little bit like I'm going to buy myself a bicycle, but should I also be buying these stocks? How do the shares in these dealers look?
The stocks have done pretty well in recent years. So during the financial crisis, they got trashed, predictably. There were rights issues, dividends were cut. The shares have recovered, but not to the extent that, say, other cyclical stocks, like, for instance, house builders have. They've all blasted past their pre-crisis highs. A lot of the car dealers yet to retake their pre-crisis highs. And also on valuation grounds, they traded about 12 times forecast earnings against a general retail sector multiple of about, say, 14 or 16. So it's still a fairly discounted sector, perhaps reflecting the generally unsavoury reputation of car dealers in the past. There's a bit of a sort of stale cigar smoke and the sheepskin coat still lingering there in people's minds.
Well, we'll take the disreputability discount. Thanks, Jonathan.